Most freelancers who go under weren't actually unprofitable, they just ran out of cash at the wrong time. A client paid late or a slow month hit and there's nothing left in the bank. Today I'm walking you through a simple system to make sure that never happens to you, what to track, what to build, and what to do when things start looking tight. Quick note before we get into it, this is a financial education, not financial advice. I'm sharing with you what I've learned, and for your specific situation, always talk to a professional. Okay, let's start with the most important thing, profit versus cash flow. Profit is total revenue minus total expenses. It's an accounting number. It's calculated over a period of time, either a month, a quarter, or a year. Cash flow is different. Cash flow is the actual money moving in and out of your bank account based on when things actually happen. When your client pays, when your client bills come due. And here's the problem. Those two things can tell completely different stories at the same time. Here's a real example. You invoice a client $8,000 in October. They're on net 60 terms, which means they have 60 days to pay. So the money shows up in December. Meanwhile, in November, it's your rent, your software subscription, your phone bill, all of it is due, and your account is nearly empty. On paper, October was a great month. In real life, you're stressed, you're scrambling, and you're profitable and broke at the same time. That's the gap, and for freelancers and self-employed, that gap can be brutal. Why freelancer or self-employed are more exposed? A salaried employee gets paid on a schedule, same amount, same day, every 2 weeks. As a freelancer, you're the one chasing the schedule. There's no payroll department cutting you check, no employer buffer, just you, your invoices, and however long your clients take to pay. And three things make it especially hard. First, your income is irregular by nature. Second, net 30 and next 60 payment terms are completely normal, meaning clients have a month or two to pay, and that's expected. And third, you probably don't have access to the same credit lines as a larger business does. So when cash gets tight, your options are limited. Think of it like driving without a fuel gauge. The risk isn't the destination, it's not knowing how much fuel you have left. Drop a comment below if you ever had a month where money was tight and you didn't see it coming. Okay, here's the actual system, and I want to keep this as simple as possible because simple is what actually gets done. Two numbers, that's it. Number one, money in. This is confirmed received payments that actually cleared your account this week. Not invoice, not promise, cleared. Number two, money out. This is everything committed and due this week and next. Subscription, rent, contractor payments, any HST remittances you have coming up, anything scheduled to leave your account. The gap between those two numbers is your real cash position, not your invoice total, not your profit and loss statement. You don't need a fancy system to start. A spreadsheet works. Most people who struggle with cash flow aren't doing some complex thing wrong. They're just running out of gut feel and their bank balance. Starting here, with those two columns put you ahead of most. And if you rather skip the spreadsheet, I use QuickBooks to track this automatically. It connects to your bank, categorizes your transaction, and has a built-in cash flow planner that shows your projected position 30 to 90 days out. So you can see a gap forming before it hits you. Link is in the description below. Heads up, that's an affiliate link. I may receive a small commission if you sign up, and I use it myself. I only mention tools I actually find useful. Know what to do when cash look tight. First thing to know, this is usually the timing problem, not the failure. Most cash crunches are predictable if you're tracking. The goal is to act early before you're already behind. Here's the order of operations. Step 1. Start with slow paying clients. A polite follow-up on an outstanding invoice is the fastest cash move you can make. Do that first. Step 2. Defer non-critical spending. Subscriptions, upgrades, anything optional, push it. Don't cut tools you need to generate income. Cut everything else. Step 3. Delay or renegotiate payment terms with supplier. If the invoice says net 60, don't pay it until 60 days. And here's one that catches a lot of Canadian freelancer off guard. HST. If you're registered for HST, that money is not yours. The moment it comes in, a portion of it belongs to CRA. A lot of people mix it into their operating cash and they got surprised when the remittance is due. Set it aside the moment it lands. Keep it in a separate account if you can. Now, how to prevent tight cash flow? The answer is building a 6-month operating expenses buffer, and this is your first line of defense. The goal is simple. Keep 6-month operating expenses sitting in separate high-interest saving account or HISA, not your checking account, a separate one. For most freelancer, operating expenses like software, phone, home office, accounting, any subcontractors aren't actually that high. Add up 1 month of those costs, multiply by 6, that's your target. Why 6 months? Because freelance income can go quite fast. A key client pauses, project ends, a slow season hits. 6 months give you time to respond without panic. You're not scrambling for the next contract from a position of desperation. This buffer isn't an investment. It's not meant to grow. It's meant to sit there and buy you options like a shock absorber between your business and whatever market throws at you. Build it gradually. Take a percentage of every payment, even 10%, and move it to that account automatically. Over time, it builds without you really noticing. One caveat: the right numbers varies. If you have one major client on net 60 terms, you might need more. If you have 10 steady monthly retainer clients, maybe less. Use 6 months as starting point and adjust from there based on your payment cycle and how comfortable you are with risk. And here's the recap. Cash flow and profit are not the same thing. You can look great on paper and still overdraft. Track your 2 numbers every week, money in, money out, and know your real position, and start building towards 6-month buffer, 1 deposit at a time. 2 habits. Start this week. 1. Open a spreadsheet or QuickBooks and write down every dollar coming in and every dollar going out in the next 30 days. Do it once, see what you're actually working with. 2. Open a separate saving account or HISA. Label it OPEX reserve. Move whatever you can, even to $100. The habit matters more than amount right now. Cash flow problems don't usually come from bad months. They come from not seeing the bad months coming. Be wise with your cash flow, and I will see you in the next video. Bye.